In segment 2, we want to look at what is happening with demand, how are things changing in terms of the amount in storage. And one of the things that we continue to see is just that this lumpiness when we look at where's demand, where does actual demand showing. And as we said in the title, we got a drop in demand overall, but we do expect to see a strong bounce and a bit more of a decline as we go through. Again, very much along seasonal norms or just below seasonal norms, but really tracking similar in terms of just when we get an increase, when we get a decrease, not too much one way or the other. So when we look at the current, the current flow is about 14.925 million barrels a day of demand versus last week's 15.687. So you're starting to see that come just below that 15 million level, which is really where I think we'll live through. Obviously we'll get a bump as we go into Thanksgiving and how just how cold things get. Where is the winter? So when you look at just where we sit right now, I think you'll see the rolling average come down just below where we were in 2017. But I'm expecting this to have a similar pattern to where we were in 2017, just at a slightly reduced level versus that point. And again, obviously well above where we were in 2020, but just not quite back to normal yet, just as we get some of that mixture back and forth. So that 4-week rolling average sitting at about 15.287 million. That's something that we'll just trend a bit lower and come closer to that 15 million level, and then have some of those movements that we've seen just based on what is the holiday schedule, how are people moving about. So then when we look at distillate, so distillate had a small draw of 430,000 barrels. That's 11.8 million below the 5-year average. But when you look at the breakdown, again, Pad 1 had a draw of 240,000 and it's 11.1 million below the 5-year average. So when you look at it overall, Pad 2, very much in line with the 5-year. Pad 3, same thing, 4 and 5. It's really Pad 1 that is driving a significant amount of this drop. But that's meaningful. That I'm not discounting that by any means, because where do we consume the most heating oil but in Pad 1? So that's where you're going to continue to see New York Harbor driving that. And then the shift will come, how much of that can come through imports. And then when you look at the import number, we had a big increase of 110,000 barrels a day into Pad 1. That took us on a net for the week. We had an increase in imports of 123,000 barrels a day, and that's 154,000 above the 5-year average. Again, really driven by Pad 1, as that arb remains wide open, coming from Europe into the U.S. and more behind it. So that's going to keep flow coming from Europe, coming into the U.S. just based on where those shortfalls are. And we do expect to see more rail traffic going from Pad 3 into Pad 1, trying to also close that arbitrage because it is wide open between one and the other. Now, when we look at demand, we were expecting a small drop into the 5-year average. Instead, we got a bigger drop through it. We just think that you'll get a sizable bounce. And it's really because we have a bit of a lag between when things are coming on shore, when it's getting onto a train, when it's getting onto a truck. And that's where we're getting some of that lumpiness. So we do expect to see some of this recovery, but there's also this lull in terms of where heating demand is. It's starting to pick up. We're starting to see that come through. And the question is going to be, what is the sticker shock when people get their first heating bill, which will be an interesting one. Here we had a small drop from where we were on the trucking demand. We do see that, again, reversing higher as load availability still remains elevated. The issue is price. Where is labor and where are rates? Because diesel prices just are driving higher. I mean, we are looking at diesel prices just every single week, 5, 6, 7, 8 cents increasing week on week. And that is very difficult to pass on in the short term, or people are like, look, I'm just going to live off of whatever inventory I have and I'll wait for this, because you're starting to see some of this backdrop. But we still have low inventories. We still need product. We're still coming into the holiday season. So we do expect this to just move back closer to where we've been between that 130 to 160, 170, and just live within that level through the end of the year, really, because even as we try to fill holiday shipments, then it's a matter of replenishing what has come out from holiday shipments. So we will see some of that activity. As rail continues to see a bit of a bump on total carloads, that was really driven a significant amount by coal. We're going to continue to see coal be a driver. Excuse me, grains had another, are starting to normalize again as we're getting a big pull into the export market. Forest products, farm products, again, all of that is going to continue to be strong. Same with coal. Metallics, ores continuing to be strong. Motor vehicles and parts, that's going to continue to be weak just because you have the supply chain issues. Petroleum and petroleum products are continuing to close that gap, and we just think that that's going to continue and not really close the gap completely into versus 2020, but just close it in general, just getting closer to where we were and probably just 1% or 2% off of last year, but still getting to that level as they try to close that gap between where we were in pad 3 and pad 1. Intermodal continues to be underwhelming when you look at where things were versus this week last year, and that they're going to close that gap. Like I expect this to be only about 2 to 3% below last year, but because of those residual issues on congestion, on labor, and still chassis not as much as it was. It's about 95% of normal. All of that will continue to be an overhang when we look at just intermodal traffic. Had a little bit of a slowdown in what is showing up for October, but it's really the eye of the storm at this point, where it's the lull before the surge. So they're trying to clear things faster. They're increasing, or they're taking away they're waiving how high some of these things can be stacked, just because they're trying to just get all of the stuff off the boats, get it onshore, and then worry about trying to clear it through the system. So that's decreasing some of the amount of volume that is waiting on offshore. But there's also that lull between when it left China, which was really let's call it the last week of September, first week of October, and showing up. So we do expect this to see a steady increase through November. So we're going to continue to see that ramp back up. On the heating demand side, we're starting to get a little bit cooler temperatures. You're starting to see that shift a bit colder, especially when you look at the Midwest and into pad 1 or the East Coast. So we'll start to see a little bit more heating demand or heating demand days, and that'll help not only natural gas, but that'll also help some of that heating oil, fuel oil start to move through the system. Now, when we look at gasoline, you can see that gasoline had a draw of 1.99 million. There was a draw across the whole board. But when you look at gasoline versus the 5-year average, it's only 6.5 million below the 5-year average. And shocking, it's really driven by pad 1, which is 6.3 million below the 5-year average. So that's where we continue to see some of this pushback. And as we said last week, we expected to see a fairly sizable, a decent drop below where we were last week on imports, as we saw that dwindling amount coming from Europe. We're just 80,000 barrels a day below the 5-year average. We're 114,000 barrels a day below where we were last week. We're going to get to this kind of stabilizing level where we're going to get to let's call it about 400,000 barrels a day of imports. And that's where we're going to kind of sit, something just below normal. You can see when you look over the last 29 years, we normally have that dip in storage. We just expect this to follow the pace almost perfectly when you're looking at it versus historics. And it could actually start to increase a decent amount. The question is going to be, what does the export market look like? Because as refiners ramp up to meet that heating oil demand or that heating demand, that's when you'll see that gasoline start to build in the system. And then the question will be how much of that can be offloaded into Latin America and into the broader market. And that's going to, again, keep some of that arb closed, which is why our imports will stay fairly small. But then when you look at the shift, so when we look at production, so gasoline had a decent increase in production in general on the yield side. Yield was up about 70 basis points. But when you look at distillate, yield was up almost 1%. So again, that's as you see yield increasing on the distillate side, you'll naturally see gasoline as well. They're just going to try to do as much as they can to kind of minimize some of that and to focus as much as possible on the distillate cut, diesel cut, and even if they can, the kerosene side, just to try to manage underlying storage. And then when you look at blending components, it had a draw of 2 million, and that brings us we're only about 500,000 above the 5-year average. And again, that's also going to be how do you manage blending components versus gasoline and really try to play up that disty cut, because and it's going to come down to how are your catalysts set up, what kind of crude are you running, which is why we do expect them to continue to get heavier and stay fairly sweet just based on where the demand is. But when you, and we'll go through this more in segment 3, there's a big flip in terms of what is in demand right now, with those sours seeing a pretty sizable drop in demand, with the sweets starting to see a bit of that increase. And you're seeing that really play out in the physical market, which we'll talk about in a minute. When we look at gasoline demand, it weakened a bit versus last week, but last week was a fairly strong week, so we do expect it to kind of to normalize a bit more. According to Gas Buddy data, weekly U.S. gasoline demand fell 0.5% from the prior week, but was still, again, 0.2% above the 4-week average. But so far this week, we've seen a fairly sizable drop, where according to Gas Buddy, Sunday U.S. gasoline demand fell 3.9% from the prior Sunday and was 2.6% lower than the average. And then Monday, U.S. gasoline demand fell 2.3% from the prior Monday and was 0.4% lower than the average. You also have to factor in weather. We had a fairly sizable nor'easter come through the Northeast, really dumping a ton of rain between Sunday and Tuesday, depending on where you were and what time it was. So again, that is going to have a bigger impact. And then there were other storms on the West Coast. All of that is going to just reduce where the demand was. People just are saying, look, there were travel warnings, essentially saying, hey, if you don't have to drive, don't. So that also is going to eat into where demand is this week, but we just expect it to be very seasonally normal otherwise. This is going to be that bigger overarching issue that we've talked about. So gasoline prices are up another 6 cents. They're now at $3.39. We should be at above $3.40 by the end of the week, by really the end of the week or beginning of next week. San Fran and other parts of California are actually at all-time highs when you're looking at gasoline prices. We're well past the point where you start to see some of that demand diminish a bit, and we think that that's going to see a bit of an acceleration. On the other side, when you're looking at diesel prices, diesel was up another 4 cents, continuing to see that climb higher. We're now at $3.71 on our way to $3.75. Just based on where taxes are, where things are shifting, and where that kind of that late surge is going to come in, it's very likely that we will be over $4 before we get to Thanksgiving. So then when we look at blending components, just giving you that idea, very, moving along that seasonal norm where we've kind of clustered. This is where they're going to try to manage exports. Some of this can be used as feedstock for petchem. Again, trying to just manage and shifting away, because we do have a lot of blending components, trying to really maximize that disty cut in general. Then when we look at total, going back the last 15 years, we had the drop. We had a spike a bit earlier than normal, a drop a bit earlier than normal when you look at where we are in the top of the range. Again, it's just a matter of timing, nothing too crazy one way or the other. And then when we look at the last 5 years, you can see that we're now back below where we were in 2017, 2019, and we're moving closer to where we were in 2018. And I think you're going to see one more kind of spike up, just based on people that didn't go out. That delay in terms of shipping, getting obviously trucks to the racks and then back to refill. So one little pop, and then when you look at historically, we normally have that steady drop over the next 2 weeks, and I just think that we're going to settle out just below where we were on that low point, and then just see a fairly normal move just below seasonal norms, obviously well above 2020, but just below where we have been the prior 4 years, and just kind of bumping along that level. And the reason why we say that is because we continue to have that difference when you look at workplaces, where we're still about 20% off of normal. That, I think, is just going to continue into year end, as many places have maintained some of that normalcy of let's wait until January 1st to bring people back, or at least I should say Q1 of 2022. Parks will continue to come down. Very much just how much do people want to tolerate the cold. The nicer, warmer weather lasting a bit longer has helped keep parks active. And then when you look at the residential side, grocery and pharmacy side, again, things are fairly normal. Here, when we look at Apple trends, they've come down versus last week, but still remain elevated. We just expect this to continue to move in a very seasonal, normal pattern, so nothing too crazy to write home about. And then when we look at the underlying for propane, propane had a nice build of just over 2 million barrels. We're still about 13.5 million over the 5-year, and it's all driven by Pad 3. So when you look at the 5-year average, Pad 1 is normal, Pad 2 is normal. Pad 3 is 13.7 million below the 5-year average, and it's all driven based on the elevated amount of exports and just the amount of petchem capacity that has been happening. We're now just below the low point from 2017, but again, we expect to either be just above it or just below it as we kind of set this normal level as we go into year end, and days of supply will likely cross just back into that low end of the cloud, but still be tracking fairly reduced into year end. And the fact that things are shifting a little bit colder is going to help accelerate some of those movements. Then when we're looking at kind of broader themes, you can see that vaccines administered still remain healthy. India had a nice pickup. US stays fairly flat, with China still kind of bumping along, but with the renewed provincial outbreaks, we expect to see that accelerate again, as it normally does when you have an outbreak, especially in China. And then when you look at just vaccinated, as we get to these percentages of 65, 70%, things naturally slow down. So again, nothing too crazy one way or the other. And then when we look at jet fuel demand, so jet had a draw of 400,000 barrels, again, just 300,000 below the 5-year average. They're just going to try to manage this against the average and try to maximize what's in the disty cut. And then when you look at where we are, as we've been saying, between that 1.35, 1.4, 1.5, 1.5, 1.6, we're just going to be very seasonally normal, just at a reduced rate as that continues to play out. And you're seeing it on the global summary. North America, a bit elevated. Rest of the world is coming back a bit. Asia Pacific has slowed down, obviously, with China having that outbreak. And things in Europe are just dipping along seasonal norms. Nothing crazy. The average number of departures per day decreased by just under 1%. Obviously, that was all driven really by China. Globally, the passenger flight schedule for the 11 weeks ahead has declined by 1.5% since last week. We expect that to continue to be the way, just again, as we go into the winter months. And you normally seasonally have less demand, but again, it's just going to be a bit more than normal just because we still have limited international flights and we just don't have as much happening in general. And then in Asia Pacific, departures in China decreased week on week due to a fresh virus outbreak in central China. Jet fuel demand in Asia Pacific could increase by about 560,000 barrels per day in the coming 12 weeks as they get to the other side, just to give you an idea of some of the swings that we could see in general. But TSA passengers, as we've been saying, just seasonal moves up and down, just at a reduced rate of about 850,000 versus 2019. And then as we continue through the restaurant side, weekends 5% better than normal, weekdays 10 to 15% worse than normal. That is not something that we see changing really, especially as we go into the winter months. And people just, either opt to not sit outside, not because they don't want to be inside, or they feel a bit better about being inside, but not everyone. And we just expect this to kind of be the normal gauge as people maybe do a little bit less heading into Thanksgiving, again, trying to be a bit more cautious just because they want to see family. So with that being said, we might get a little bit of an increase in the drop ahead of Thanksgiving, and then a nice Thanksgiving drive, and then things paring back a bit again. So now that we've gone through the U.S., we want to look abroad and do a bigger look at what is happening in the international market and how the U.S. kind of plays into that overall.